what comes after melt-ups is melt-downs. So we would see a growing into the valuation multiple, a little bit of choppiness within the market as actually something welcome as long-term investors, even if it is something that will be a little bit jarring as we go through it because we've been used to this up into the right market.
Hi there, I'm Mike Larson, host of the MoneyShow MoneyMasters Podcast, and I'm coming to you from the MoneyShow Orlando. Today I'm speaking with Cameron Dawson, Chief Investment Officer of NewEdge Wealth. Cameron, how are you?
I'm wonderful, thank you. Happy to be here.
Yeah, I'm glad you could. This is a new show for you, as I understand, so Thank you for coming. Why don't you talk a little bit about your background and what it is that NewEdge Wealth does?
Sure. So I've been the Chief Investment Officer at NewEdge Wealth for about 2.5 years now. NewEdge Wealth is a private wealth manager that is hyper-focused on ultra-high net worth and high net worth investors. We also have a business called NewEdge Advisors as well, which is a mass affluent platform. We invest across the asset class spectrum, so everything from traditional equities and fixed income down into alternatives as well. My background coming into NewEdge Wealth is I had spent a couple of years as a chief market strategist at another RIA, but then I spent 8 years working for Bank of America, where the majority of that time I was an industrials analyst. So I was an equity buy-side analyst, getting deep into the fundamentals of companies and highly cyclical companies, which of course lends itself quite well to making predictions about the broader economy and markets.
There you go. And of course, you're here in Orlando. Your hometown background wasn't hard to get you to come down, right?
Most definitely. I'm born and raised in Orlando, proud to be so, and so happy to be able to come down, see some family, and meet some great people.
Excellent. Well, let's talk about this market environment. I mean, I know you're going to be giving a talk that's kind of big picture. What are some of the themes you're seeing out there, and what are your thoughts here as we apparently keep setting new highs?
Yeah, it is pretty incredible, but when you put it in the context of the backdrop of this market, we think that it starts to make a lot of sense as to why we're keep pressing to new highs. What I mean by that is that if you think about fiscal stimulus, which remains highly supportive and stimulative, monetary stimulus now at the same time that is shifting to a more stimulative stance, all at the same time that you have a relatively robust economy. That mean you have fiscal running at full speed, monetary running at full speed into a strong growth backdrop. You don't see that often. And whatever the opposite of toxic brew is, your perfect scenario, that seems to be how risk assets are taking it, because you can see risk assets like equities trading at 22 times forward, back almost to the peak we saw post-COVID. You see credit spreads compressing to their lowest levels since times like 2005. So what you have is a market that we think is very much priced for perfection that has a few implications. It means that there's not a lot of wiggle room for downside surprise. It could mean that if growth disappoints, or let's say yields move higher, it could be a source of volatility, but it also shows you just how beneficial this backdrop and environment is. We just have to ask the question, how long can it last?
Yeah, no, I understand completely. Let's talk about a couple of those things one by one. The Fed and monetary stimulus. Your thoughts on the Fed's 50 basis point move and kind of what you think they're going to be doing as we roll into 25.
We thought it was an aggressive move. We were looking at things like growth continuing to remain resilient. Yes, we saw some fraying around the edges within the labor market, but the Fed has convinced itself that its policy is very tight and it is weighing on growth activity. And yes, that is true if you're looking at things like housing, if you're looking at manufacturing. But when you look at the data in aggregate, what you actually see is that the entire time that the Fed has had real rates, remember that's your nominal Fed funds rate minus inflation, the entire time that that real rate has been positive, the U.S. economy has been growing above trend and growth forecasts have been rising. So it's really hard to empirically argue that you have policy today that is absolutely keeping growth at a very low level. And the challenge that you have now is that if the Fed actually delivers on all of the cuts that it's saying it will, remember Austin Goolsbee saying we have hundreds of basis points of cuts ahead of us, then you would have the deepest, most aggressive, non-recessionary cutting cycle in the last 40 years into an environment where financial conditions are already not extraordinarily loose. You're a little bit tighter than they were in peak in 21, but still loose and stimulative, which is why another attendee of this conference, Ed Yardeni, has been talking about the risk of a bubble, a melt up, because you're just throwing lighter fluid on a fire that's already going.
Yeah, absolutely. So let's look at the election scenario. Obviously, that's on everybody's minds as we're meeting. We're only 3 weeks out, or a little less than 3 weeks out from the election. What are your thoughts on how that's going to shape things? Again, given what both candidates have talked about.
Yeah, it is interesting that typically we see volatility going into an election and then a rally coming out of the election. So we should not be too surprised if we have low volatility going into this one and possibly some more volatility coming out, because whichever way this election breaks, we know that there are potentially both deficit increasing and growth dampening policies that could be enacted on both sides. If we think about it, we have to consider things like higher corporate taxes, immigration, tariffs and trade. All of these things, if enacted by either party, could potentially weigh on growth, but you also have this promise of higher deficits as nobody's talking about austerity. So we think that the election could end up being volatile or a volatility-inducing event for the bond market, potentially. And we do think that you do have this potential that some of these policies could weigh on growth. But this all comes with a really important caveat, which is that all through my career, I have been fielding calls from clients the day after an election that says, my guy or gal didn't win, sell everything, I'm moving to Canada. And by definition, that is the wrong move. And so we think it's really important that investors take the emotion out of it, that they effectively see the market, whether effectively not in an election year to start, keep that emotion at bay, because yes, it's a personal thing to go through elections, but the market isn't personal. And so the end result being is that markets do what they do in spite of or despite what goes on in Washington, which is great news.
Absolutely. Let me ask you just briefly about some of the alternative investments, things like real estate. That sector obviously was kind of in a wasteland for a while, seems to be getting a little more momentum. We've seen gold at all-time highs and very strong this year. Any thoughts on what investors should be doing in sectors like that?
Yeah, we think it's the first step within alternatives is one of making sure you know what you own and why you own it. This is absolutely imperative, because what we know with alternatives is that you give up things like liquidity, you do pay higher fees, and so you have to be very clear as to what role an alternative investment plays in a portfolio. From there, it's making sure that you are highly confident in the managers that you're working with, that have deep expertise, have long histories of being in these markets through cycles, that can navigate what are, as we know with real estate, very choppy cycles. I would agree with you that real estate is creating opportunities, and we usually see disruption as a source of opportunity. So because of high interest rates, because of the overhang of high prices in 2021, we know we have potential opportunities within real estate, which is why we're looking for opportunistic ways in order to get exposure, and being very careful of where we are within the capital stack of real estate, preferring more debt versus equity at times. But if we look overall and broadly, we continue to see great opportunities within alternatives, but it takes a lot of due diligence. It's a rather strenuous process, because the need to have high degrees of confidence, mostly in long life kinds of vehicles, 7+ years, it's imperative that you choose correctly.
Absolutely. One question I guess I would say in the traditional stock arena, are there sectors that you're more positive about for the coming year than less, and anything that you would probably steer people away from at this point?
Well, we do think that there's opportunities throughout all sectors, meaning that the way we approach our equity portfolios is that instead of being top-down and saying we want to overweight one sector versus another because of some top-down view, we let the sector overweights really be driven by our bottom-up analysis. And that bottom-up analysis is all quality-based throughout our different strategies, whether it's large cap growth, values, mid cap, and international, we define quality in very specific ways, meaning we're looking for companies that have strong free cash flow, strong return on invested capital, stable profits through cycles, strong balance sheets, and that there are times that those kinds of companies will underperform. Junk does rally. You do have trash rallies all the time.
Sure.
But what we find is that through the cycle, those quality companies really do prove their worth by being able to have what we call better downside capture, meaning they go down less when markets swoon, but they also have really good upside participation, meaning that they're not sitting on their hands and as the rest of the market is rallying. There's one important point with all of that is that there are a lot of quality companies that are very expensive.
Yeah.
So that's the last piece of it, is that we do have a valuation discipline that we put into our work to make sure that we're not paying too much for those great attributes, because what we find is that a year like 2022, great quality companies drew down 30, 40, 50% because they got so expensive. So that valuation discipline is a necessary component of maintaining that kind of quality.
One last question I think I want to ask is, it seems like a fairly optimistic scenario, a pretty positive outlook. What would you be, if you had to say one or two things that could derail that scenario, that could take the base case and steer us in a worse direction?
I think the biggest risk to this market is that earnings for 25 and 26 are not properly calibrated, meaning that we have to go through an earnings revision down cycle. And when you're cutting earnings, you get a double whammy typically. You get earnings that are being trimmed, and you get valuations that are pulling in, because when you have less confidence about your growth outlook, you tend to pay less for whatever stock or piece of credit that you're buying. So because we're going into 25 priced for perfection and growth estimates are high, the thing that we have to keep a really close eye on is if you start to see those estimates get cut and trimmed, that exposes you to derating the valuation and taking those growth numbers down. And I would add one last point to that, is that if you look at allocations to equities, meaning you can look at household allocations or overall fund allocations, they remain near cycle highs, which just means that everybody is already positioned for stocks to keep on going and keep on making new highs. So our base case to be conservative in 25 is a bit more of a sideways and choppy market. And we actually see that as a good thing. It means that the bull market could continue versus going off and going straight up and kind of dying out in a flame of some
parabolic. The Eddie Ardeni scenario, too much of a boom, too much of a good thing, I guess. You don't want to see that.
Exactly, because what comes after melt-ups is meltdowns. Yeah. So we would see a growing into the valuation multiple, a little bit of choppiness within the market as actually something welcome as long-term investors, even if it is something that will be a little bit jarring as we go through it, because we've been used to this up into the right market. So the bar is high for expectations, but at the end of the day, we never want to bet against the great American might of earnings growth. It's been incredible. So we think that at least in the short term, our view has been one of respect the uptrend, but don't ignore the risks.
Perfect. I think that's a great way to end things. Cameron, thank you so much for taking some time out to chat today.
Thanks for having me.
Got it.